President Trump's one big beautiful tax bill is just past the House. It's on its way to the Senate and could be signed into law.
On this vote, the yeas are 215, the nays are 214, with one answering present. The bill is passed.
It's a massive document, so I have not reviewed all of it. There's hundreds of pages. I'm going to link to it below so you can review it yourself. But I'm going to be telling you the top 7 takeaways that are, in my opinion, are what business owners are going to care about. I'm going to tell you about what things are changing so you as a business owner can take advantage of it and what might happen if you don't do anything. And at the end, I'm going to share with you what I am personally doing about it with my companies. And I'm going to give you a bonus that they're going to help around childcare, which will greatly help small businesses out. So we're going to get to it. First thing, before we get any further, you need to know what taxes are and be like, oh, Hugh, what are taxes? It's when the government takes money from us. No, taxes are the way for the government to incentivize behavior. For instance, in Germany, there's a 90% tax, or there was, on profit for corporations. Oh my gosh, 90% tax on profit. That's insane. Why? It's because the government of Germany wants to incentivize VW not to have profits. Instead, they want to incentivize them to spend the money that they come in to buy more machinery, to hire more people, to expand their growth. And so that injects that money back into the economy. So a lot of people know in the Business Wealth Blueprint, I built a lot of my wealth in real estate, and I teach business owners how to build wealth by running their business awesome and then investing that in things that make money. These tax advantages and strategies are very, very interesting, and that's why I'm bringing them to you now. So in real estate, it is very, very tax incentivized. That's why people say, oh, Donald Trump didn't pay taxes. No, he didn't pay income taxes. He paid tons of property tax. The employees pays taxes. There's millions and millions of dollars. But why is the tax break in real estate so much in most everywhere, even in left or right-leaning states? The reason why is because it incentivizes people like you and me to go into dangerous neighborhoods and turn dilapidated properties and move the ball forward. It's incentivizing our behavior to go do the work in turning bad neighborhoods so the government doesn't have to step in and do that. So that is what taxes are. They're a way to incentivize behavior. And so the very first one is going to be a doozy, and it's awesome. And it is 100% bonus depreciation is probably back. And I believe there are some stipulations. It is section 168K for those of you who want to go look at it. But effectively, businesses will be able to write off certain pieces of equipment, vehicles, and certain real estate assets. And it's going to make that permanent. So it's 100% bonus depreciation. I believe it is currently, the way it's written, is on properties after a certain date, which is huge because it's incentivizing us to go out and build more housing. And what do you know? United States has a housing shortage. So if you own real estate or you are incentivized to make real estate better and add more to it, you are being rewarded. Next one, the Section 179 cap has been increased. That is a fancy accounting term. It is in the tax code, but it is raising from $1 million to $2.5 million. And the phase outs start at $4 million as it's currently written. This allows small and medium-sized businesses to deduct the taxes up front. And so what is this? If I go buy an equipment over a certain amount, like let's say I need to buy a bulldozer. If it's above a certain weight, then I will be able to 100% depreciate that in year one. And so that means that I really spent the money to go buy the bulldozer, but I get to depreciate that all in year one, which means I have a smaller tax burden for that year. Doesn't mean I don't owe taxes. It means it's as if that bulldozer depreciates. Now, the old way is that bulldozer is going to depreciate over 7 years, right? And so you take, let's say it's $100,000, you divide it by 7, that's how you do it. If it's $100,000 bulldozer now, that $100,000 gets depreciated right now in year one. And also, this applies to many vehicles over a certain weight rate, which is why you often see rich people or business owners family members driving expensive, heavy vehicles. Like, for instance, the Mercedes G-Wagon. The G-Wagon is very heavy and it qualifies for Section 179. So if I buy one this year, then I can write 100% of that off this year instead of paying taxes. And now you see what they are doing, but I'm not telling you to do that. That's if you have excess cash to burn. If you were thinking about buying equipment in the future, now might be the time to do it or start planning around it if this gets signed back into law, which, by the way, Section 179 is already in law. You can still do it. It's just this might be expanded in the future. So if you're going to buy a piece of mining equipment, maybe start looking at that. Qualified business income deductions are being increased, which is huge. That's Section 199A, QBI deductions through pass-through entities. That's going to be S Corps, C Corps, sole proprietors, and it's basically being increased from 20% to 23%, and it's being made permanent. So it is a lot of these regulations are basically making permanent, so there's more certainty, so we can do planning as business owners around that. Many companies that used to not qualify now will be able to qualify, and the phase-in is meant to ease the restrictions for small businesses to be able to take advantage of the deductions. Excess business losses are extended. This one's not great, and I really hope it doesn't pass in its current language and verbiage, but I'm going to get into it. So under current law, non-corporate payers are limited each year, but anything that's disallowed becomes a net operating loss that they get to carry forward, which is huge. It's great. And it can be carried forward without retesting, meaning the limitation, let's say you lost $1 million this year in your business because you were expanding and growing, and you're not allowed to write that off. You don't have the cash anymore, and you have a big loss this year. You cannot carry that forward. Under the new proposal, it'll make it permanent, and you will have to retest every year, which means you cannot carry that loss forward beyond a certain amount. So if you have a multi-year period where you're constantly losing money, then that could really impact you in a very negative way because you're not going to be able to allow to carry that forward. Now, this is going to be for non-corporate taxpayers. So, S Corps, LLCs, small businesses, partnerships like that. It's not going to be for corporations, big corporations. And so this is a really high impact. Well, Hugh, everything you said doesn't make sense. Like, why does that matter? Okay, so let's just take an example of, again, this doesn't apply to them, but through factors completely out of the control, let's take someone like Southwest. We know they're an airline. They had a great business strategy for 50 years, and they recently got taken over from a hostile takeover because for the last 3 years, they've lost money. Well, guess what? The entire industry for travel has lost money, and the entire industry for travel has lost money for good reason, and it was out of the control, which was COVID, then impacted travel restrictions that then did all kinds of stuff. So there was a surge in travel. Factors out of control. So they have had a multi-year loss. If you are in a business that is seasonal, or you're in a business like, let's say, luxury good market, you sell, I don't know, Lamborghinis or something, you could be operating your business and just say, you know what, I don't care. I'm going to constantly inject money in. I'm going to get through this with my team. Well, guess what? Under this new provision, you will no longer be able to carry that loss forward indefinitely. You're going to be subject to the limitations every year, which means if you have losses that compound, when you start making money again, you were just punished for the last 3 years and you don't get any realized benefit. So this is a bad one, in my opinion. I hope it doesn't pass, and I'm going to be watching it very closely. Basically, this means that businesses with ongoing losses could face repeated delays in the ability for them to be able to deduct those losses, and they might have to owe taxes with money they don't have. So again, if the previous section was, hey, we're going to expand this, we're going to try to inject money into our companies, they've now spent the money. They're not allowed to deduct it under old tax codes. And now if they have a loss because they're trying to expand their business, they could be punished for this, which could lead to less jobs overall, which is not great. And basically, this means that it reduces the short-term tax relief of, hey, you know what? Last 2 years you've had losses, last 3 years you've had losses, and because you're expanding your business, now you get to realize those lost deductions for your next year. That will be limited now and made permanent if this goes through. So I hope that doesn't. You better believe that I'm going to be watching this one very closely. The limitation on businesses that have losses for non-corporate taxpayers are made permanent. So this is going to be your S Corps, this is going to be your C Corps, sole proprietors, that kind of a thing. The maximum amount of losses made in 1 year is $313,000 for single filers and $626,000 for married filing jointly. The bill also changes the manner in which the taxes can be taken. Under the current rule, excess losses are treated as net operating losses for future years and are not included for this year. Meaning if you made a loss last year, you carry that loss forward and they're not included in how much that loss will be on years forward. So this will also change the way that works. We're gonna have to see the legislation on that because that could impact real estate owners, could impact business owners. That one might end up impacting people with real estate professional status where let's say you're a doctor and you're married to a real estate professional, you can offset your losses. That could impact that greatly. Business owners, are you aware that I have a newsletter down below in the description, and it is full of all the tactics and stuff that if I put it on YouTube, I will be demonetized. It is a weekly newsletter that will go out telling and talking to you guys about the things that will help you and us, our businesses, stay ahead. If you're interested, check the link, click the link below. Now, back to the video. Number 5, enhanced deductions and flexibility around R&D costs. A big thing is it's expensive to do R&D in the United States. So you can deduct those way more than before. And this is designed to spur innovation and people spending money on R&D in the United States. The next part is Section 199A. We'll also talk about business interest deductions. Taxable income for businesses is effectively going for stocks and net interest earned. Dividends is going to go from 37% down to 28%, which is huge. And number 7, international tax changes and foreign tax policies. And we are introducing some penalties in there. So it's going to make permanent lower tax rates on the GLITI, which is the Global Intangible Low Tax Income Inclusion Deduction amount. It's lowered from 50% to an effective rate down to 10.5%. And the foreign derived intangible income is also lowered from 37.5% to 36.5%. But as a trade-off to making those lower income things permanent, we are also introducing penalties for countries who have unfair tax regulations on U.S. digital assets or other U.S.-based companies. So if you live in a country that has unfair taxes on a U.S.-based company, then you might actually see a tax increase as an expat. All right, bottom line. So what does all of this mean? These are the top 7. I told you I'd give you a bonus one. The bonus one is a deduction for child support. There's 2 things about child support. One is just the standard child tax credit, and that's going to make that permanent. But then the employer provided child care credit. So it expands it from $150,000 to $500,000 for large employers, which could be a great thing where we as businesses are desperately needing to hire people, and you might have some awesome childcare facilities on site, and that will have massive tax implications now, being able to offset your income, which is huge. It's going to be a big impact for small businesses, and it's basically incentivizing employers to provide childcare, and that is going to be a good thing for everybody in the community. So that's great. All right, bottom line. What does all this mean, and what are we doing? Immediate cash flow is the bottom line. If this passes with everything in it as is, then Section 179 and other business tax deductions, it's making things permanent that already existed or used to exist. So one, there's more predictability, and we have an improvement in cash flow, right? If you are buying equipment, maybe you were having to space that out a few years. Now you might be able to be incentivized to buy it all at once. So that is a big deal. Tax planning and certainty, making QBI deductions is big. Now there would be made permanent. That would help us for planning for many years. Again, that is just adding stability so we can plan how many employees can we have this year? How many can we have next year? Because not all of us are in a standard 9-to-5 job. A lot of our businesses are seasonal. The downside of one is potential losses and loss utilization. This one might make it in there, but basically if you had losses, you might have a bigger tax bill up front because they're limiting the amount that you can take for a loss. So that's not great. And we don't know how that's going to shake out. That may not make it through the Senate. Who knows? But that's something that you can keep an eye on. If your business has made a loss and you were operating businesses that had losses to offset your gains, then that could impact you greatly. Big investment on R&D, right? Bringing things back here into the country, making it easier to deduct machinery costs, making it easier to deduct the R&D. That is designed to attract and keep and maintain our own industry, which is huge. And because this is all so different, another impact is there is now more complexity being added. There's almost always complexity being added, but with the foreign stuff, with the foreign taxes, credits versus the penalties, you might have to be a little bit more careful if you live in those places and what impacts those might have for you. With all the crazy things going on, the bill generally allows small business owners, which is 70% of the economy, by the way, to have the ability to compete, should simplify tax codes, provide stability, and increase cash flow where we can invest in the equipment to keep our jobs running, to keep things moving forward. So overall, it seems to be a good one. I am very closely going to be watching what happens as it makes its way to the Senate. This has not gone through the Senate yet, so this bill could be marked up quite a bit, but it's really critical to pay attention to. So here's what I am doing about it. One, I'm going to watch this like a hawk because it is a Republican-controlled Senate and Republican president, and it just passed the House. So that first hurdle is cleared. So there is a likelihood that this is going to pass. Will it pass in its current form? The answer is maybe. A lot of this stuff could be dialed back. They might add more stuff. Who knows? And then in which case it might go back to the House. But going back and forth, we're looking at that. I'm looking forward towards the business deductions, making tax planning and strategies around purchases especially around equipment. So I would recommend to my friends, equipment's a big deal, R&D is a big deal. They can do that. I know all of my real estate friends are going to be talking about bonus depreciation being back 100% write-off for many parts of a business. If I buy the hotel, the building needs to be depreciated over time, but the stuff inside, right? The beds, the furniture. If I want to invest the money into fixing the place up, I can bonus depreciate it all in 1 year. Hopefully that passes and come back to us. Biggest thing around everything that we're talking about though, is it's going to add a certain measure of stability across the board, because it's just making things that either currently exist or have existed for the most part and making them permanent. There's some percentages in there. It's not all good news for business owners. It's not all bad news. It's somewhere in between. I'm watching it like a hawk, and I will bring you guys an update when I find that out. And that's what I'm doing. Hope that helps. If you like this video, you might also like this video.